All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about the potential pitfalls of joining a partnerships. This came about because I had a client approach me recently to review a partnership agreement for a potential partnership that they were looking to enter. It was a partnership for investment purposes, but upon looking at it, I figured there's things that I can share, potential pitfalls, whether you're joining a partnership for investment purposes or an active business. There are some things you need to account for when setting up a partnership agreement, just to make sure that all your bases are covered and so that you're not left within a financial bind based upon the wording of the partnerships. The first pitfall that you have to account for is the wording for initial capital contribution. On this particular, the clause that I took notice of was when it said that they were looking to raise capital for the company and they had defined dollar amounts that each partner was to contribute. But there was a clause in there that caught my eye that said a partner could contribute either cash or cash equivalents or labor or services. That can be pretty problematic if a partner is allowed to contribute labor or services, unless it's agreed upon by everyone prior to. But I can see where it could create an issue where everyone thought that they were going to put up a certain dollar amount and someone comes to the table and says, I'm going to provide labor or services, because the big problem there is, how do you value that labor or service? That is very subjective. How much is a person's service worth? Because essentially you're valuing their time. The question is, what's the value of that time? So the person providing the service may have a higher value of their time. It leaves a lot of room for interpretation. So if you were to do something like that, just make sure that it's clearly defined what those specific labor and or services are, so that everyone can agree upon the value. So that's one thing. The other thing to worry about, which can create pitfalls, are distributions for taxes. So when you have a partnership, the partnership itself has its own tax return. The partnership itself doesn't pay the taxes. The individual partners do on their share of the profits of the partnership. For example, if you have four equal share partners and let's say that there was a net income of $100,000, the partnership itself doesn't pay the taxes on that 100K. Each of the individual partners have to do so from their personal return. With this example, each partner would have to report $25,000 worth of income on their personal tax return. So the issue that can arise from that is, although the individual owes the taxes on their share, the money is still with the company. So in this example, that 100,000, let's say it's still within the company, but each partner is now responsible for taxes on 25,000 that may not necessarily be in their pocket. To resolve that, most partnerships have distributions specifically to pay for taxes, but sometimes there's partnerships that don't account for that. So you need to make sure that the partnership will distribute enough money to cover the taxes, because you may agree amongst yourselves that you want to keep as much money in the business as possible to grow. But as an individual, you don't want to wind up paying taxes on money that never touched. So you want to make sure that you have enough distributions to cover the tax. There's a number of different ways to do this. Now, you also have to account for that because you're paying tax on an individual level, not everyone might be in the same tax bracket. If that same $25,000, partner A may have to pay more taxes on the same 25,000 than partner B, simply because partner A may be in or a higher tax bracket. And that can come from a number of things. Let's say that one partner is married and one isn't. And that partner that's married, combining their taxable income with their spouse's taxable income, that could put them in a higher bracket versus one partner who's not married, where it's just simply their income. One partner may have other investments or another job. The taxing system looks at all of your income in totality. It doesn't separate most forms of earned income to figure out your bracket. So it can create different tax amounts on the same dollar amount, depending upon the situation. You'll want to make sure that your partnership agreement accounts for that. And maybe the easiest thing to do is assume every partner is in the highest bracket, and then just make your partnership distributions based upon that. That way, no one gets shorted. You may have a little bit of an excess or surplus because everyone may not be in the highest tax bracket, but you'd rather have that than being short coming out of pocket and paying taxes on money you never had. So you definitely want to make sure that you account for that. Other thing is you want to make sure that there are clear and concise terms about additional capital contribution. I've seen this a number of times where everyone makes an initial investment, but there's never a conversation about if additional capital is needed. Some folks come into it thinking they make their one-time capital contribution and then that's it. But things happen and now you may be short on capital and some partners are calling for additional capital contributions to help. Some folks are on board with that. Some folks aren't. So you have to make sure that when you're drafting your agreement that you have that understanding, whether additional capital contributions are coming into play here. What's the rule with that? How do you go about doing it? Do other partners need to do that? You want to make sure that you have that accounted for. Another item you have to look for, and I think this is very important with partnerships, is keeping track of capital account. In partnerships, you have a capital account essentially lets every person or every partner know what the book value is in the company. Give an overview of how the capital account works. There are profits. Profits get allocated in proportion to the ownership to all the partners, and everyone has a capital account. So that increases the capital account. So it shows your share of the value of the company. So if there's net profits, then everyone's capital account goes up by that share of the profit. If there's a loss, that capital account goes down. If you contribute money to the company, your capital account goes up. If you take money out of the company, your capital account goes down. Scorecard, so to speak, to let each partner know this is your ownership portion or share, at least according to the books, when it pertains to their share of the ownership of the company. Now, this is very important because it comes into play in the event a partner wants to leave and there's some sort of buyout that needs to take place. The capital account is a great way to show the value of that partner's share of the company. It's a great starting point. With some of my clients, that might be the only point, but you can adjust how you want. It's a great point to determine what the value is and what that buyout portion is. Now, you may want to decide there's a premium or a discount based upon other factors, but if you really want to keep things simple, just go based upon the capital account in the event that a partner wants out. Very easy to determine what the value is, and you can pay their share, and it's easy for them to go away. Now, some issues that I've seen is that the partnership didn't do a great job of tracking this account. So when something like this happens, they're trying to figure out what the value is, and now you just pull up the straws trying to figure that out. Or you have to go through the painstaking process of going through and recalculating that. Now, that is something that should be tracked at all times because it is something that is required for the tax returns. But I've seen a number of turns where that part just gets skipped over because it doesn't necessarily impact the profit and loss at the time. But again, it could be something that's very important down the line and make life a lot easier, especially in the event that a partner wants to walk away, but the partnership is still going to continue. You definitely have to make sure that you stay on top of your capital accounts for each. So that's all for now. I hope this helped and was useful. If you have any more questions about this particular topic or any other accounting or tax related questions, feel free to reach out. I'm happy to help. All right. That's all for now. And I'll see you on the next one.